Yes guys, let's discuss AS 28. Impairment of Assets. One of the very lengthy standards out of 30 is AS 28 guys. You'll have plenty of paras, plenty of segments, and you're talking about impairment. Now first of all, let's try to understand what does this word impairment stand for. Impairment indicates loss in value. This word impairment stands for loss in the value of an asset. Now if you observe, you remember depreciation, which was A6. A6 depreciation also talks about loss in value of an asset only. But A6 depreciation is confined to three reasons. A loss in value of an asset due to wear and tear, or effluxion of time, or change in technology. These are the three reasons for which you can charge a depreciation. Any other reason, I'll give it as impairment. Now, what could be some other reason? Some other reason could be something like this. Let's say there is a physical damage to the asset. Now, physical damage to the asset is not covered by depreciation. Depreciation is a regular outflow or regular reduction in the value of an asset. Depreciation charged at the rate of 20%. Depreciation charged at the rate of 25% is a regular diminution in the value of an asset. But other than a regular diminution in the value of an asset, if there is an extraordinary reason which is causing a loss in the value of an asset, such extraordinary reasons will be covered under this impairment of an asset. Now, if you remember, depreciation is a compulsory charge to P&L. It is a compulsory charge. Every year you have to charge depreciation, whatever it is, if there is an asset which is a depreciable asset. But impairment is not that case. Impairment will only be debited to the P&L or will only be recognized on an asset if there is any indicator for such impairment. Now what are these indicators for impairment? We'll understand later on. But understand in simple sense that the difference between depreciation and impairment is, depreciation is a compulsory charge to P&L. Impairment is not a compulsory charge. I will charge impairment only when there is an indicator for impairment. And depreciation because of three reasons. Impairment is other than those three reasons. If there is a loss in the value of an asset due to effluxion of time, change in technology, or due to wear and tear on use. If these three reasons are there, then I'll call it as depreciation. Beyond these three reasons, if there is a loss in the value of an asset, I'll call it as impairment. So in a similar sense, I'll say the accounting treatment is very similar to what we have already seen in depreciation. Now, let's get into the standard. Applicability. Applicable to all enterprises. Level 1, level 2 as well as level 3. However, there is a small exemption applicable only for SME. Small and medium enterprises, that is level 2 and level 3 enterprises. Small relaxation which we'll have to discuss about SMEs. You can leave some space, we'll come back to this. I cannot explain what is a relaxation now because we don't know what are the provisions of the standard. Once we understand the provisions of the standard, then I'll tell you what is the relaxation in which provision of the standard. So there's an exemption or a small relaxation which is given for SMEs. Not from the entire standard, but only from a particular part of the standard. We'll discuss about this. Just leave some 3 lines or 4 lines space. We can fill this up later. Now, exclusions from scope. The heading reads as impairment of assets. However, few assets will not be considered for the purpose of impairment at all. Now what are these few assets which are not considered for the case of impairment? Normally, if any asset is valued at its fair value, then I will not bring them under the purview of impairment at all. If it is valued at fair value, then there will not be any impairment is what we discussed when we are talking about exclusions from scope. So, few assets which are valued at fair value are AS2 inventories, is 13. Investments. A7. WIP on construction contracts. These are a few exclusions that we discussed from the scope of the standard. We haven't covered the standard, but AS15 word called as plan assets, which is also valued at NRV, so we don't consider it here. Along with that, AS22 deferred tax asset is also excluded from the scope. So these are few assets which are excluded from the scope of AS28 impairment of assets. So I don't check for impairment for these particular assets. For any other asset, definitely I'll be checking for impairment. Fixed assets, your intangible assets, goodwill, your financial assets as per AS30, everything will be checked for impairment. Now, what is this impairment and how do I recognize impairment? Now, when I'm talking about impairment, the rule for impairment is impairment is equal to carrying value of asset minus recoverable amount. What is the carrying value of the asset? It is nothing but the book value of the asset. That is the written down value. Cost minus accumulated depreciation is giving you the carrying value. At what value is it being carried in the balance sheet gives you what is the carrying value of the asset. There is nothing but cost minus accumulated depreciation. Or in simple sense, I can also call it as book value of the asset. The value at which it is presented in the books of accounts. The concept of impairment loss will always revolve around this recoverable value. Now, what is this recoverable value about? Recoverable value is higher of value in use. In short, we call it as VIU or net selling price. In short, we call it as NSP. Recoverable value is higher of value in use or net selling price. Now, any asset, if you start defining, what do we say? An asset has benefits which are of enduring nature. Means, future economic benefits arise from use of asset. Correct? Now, a total of those future economic benefits is called as value in use. When I'm using the asset, what is the benefit that I derive from the value, from the use of the asset? That is called as value in use. What is the net selling price? If I sell the asset today, then how much I will receive from the sale of the asset is called as net selling price. Now, I am taking a higher of these two. The reason is, if obviously my net selling price is greater than value in use, that means I will receive more from sale of the asset today than I will receive from using the asset. Then obviously I will go for a decision of selling the asset, right? If I will say that from use of the asset I will have a higher value than if I sell the asset, obviously I will go for using the asset. So that's the reason why very categorically he said use higher of these two. Now, to explain in simple sense, I'll say value in use is, now value in use when I'm talking about an aggregate of all the future benefits arising from the use of the asset. Future benefit. When I'm talking about something in future, we are trying to value the impairment loss on the balance sheet date, that is today. So year 0 I am trying to value the value in use, so I'll have to compulsory show it at the discounted value. So present value of future cash flows arising from use of asset. Present value of the future cash flows arising from use of asset. Then what is your NSP, net selling price? Net selling price is similar to NRV. How do you define an NRV as per AS2? Estimated selling price minus estimated cost to sell there. Here I'll use the word cost of disposal. You don't use the word disposal for inventories. We use the word sale for inventory. For other than inventory, since inventory is not anyways covered by the standard, other than inventory when you are trying to sell, we don't call it as sale, because sale is a term which you use for operating. So if I am into furniture business, sale of furniture is a sale for me. But if I am not into a furniture business and I am still selling my furniture, I don't call it as sale of furniture, I'll call it as disposal of furniture. So I'm using the specific word cost of disposal. So estimated selling price minus estimated cost of disposal. Now, normally when we are talking about a net selling price, we always have to consider an arm's length transaction. Every time we discuss about the word arm's length transaction, what does it actually mean? Now you can't take a literal sense saying that buyer and seller have to take an arm's length distance and start transacting with it. That is not what it means. What does an arm's length transaction mean? The few ingredients of arm's length transaction which are necessary to understand the valuation are: two or more knowledgeable parties. The word knowledgeable parties are very important. That means they have an idea. The seller knows in complete sense he knows what is the good he is selling. All the positives, all the negatives. And the buyer also has an idea of whatever positives and negatives are there from the sale of an item. Now that case we are calling them as knowledgeable parties. Unrelated. These knowledgeable parties are necessary to be unrelated. They have an intention to transact. Now what is this intention to transact? Normally let's say I was going to the market to sell a phone. Okay, a mobile phone which I was carrying in pocket. I showed it to my friend and who was coming along with me to the market. And I said, what do you think? How much can I sell this proper mobile phone for? He looked at the mobile phone, he pressed every button and he said, the phone is working properly. I think you should at least get 15,000. At that point of time, if you stop him and say that, give me 15,000, I'll give you the phone. He'll say, I never had an intention to buy. I was just giving a valuation. Now you are just giving a valuation cannot be called as your arm's length transaction at all. So when I'm talking about an arm's length transaction, both the buyer has an intention to buy, seller also has an intention to sell. I can't say that, how much will you buy this item for? Says 20,000. Acha, okay, I did not have an intention to sell. I say for general knowledge I'm asking. That is not possible. So both should have an intention to transact. I want to sell and at the same time other fellow has an intention to buy. Both should exist. Now this is called as intention to transact. And the price is not negotiated with reference to unrelated items. My dad's mother is an MP, my father's wife is an MP, all that is not possible, guys. So that's what he's talking about, unrelated items. So I'm talking about a transaction, I am only talking about the buyer and the seller and the good which is there to transact. That's it. Now I can't bring something else which can influence the price. There should be nothing which is influencing the price. So uninfluenced price, which is negotiated without any reference to unrelated items. Then I will call it as arm's length transaction. These arm's length transactions are also called as fair value. The value determined in an arm's length transaction is normally used by the term fair value. Now, this is what we call a net selling price. So, two things to be identified here. One is a value in use, other one is a net selling price. Higher of these two will be coming into a valuation of recoverable value. So, in a general sense, I am talking about to identify impairment loss, I will consider the book value of the asset and compare it with the recoverable value. To identify the recoverable value, I will compare two variables. One is a value in use, other one is a net selling price. However, there are two particular situations or two peculiar conditions where I will not consider higher of these two. Now, what are these two peculiar situations? Determination of recoverable value. Now, what are these two peculiar situations? Let's talk about. The first situation will come up something like this. If the net selling price of an asset cannot be identified if the net selling price of an asset cannot be identified on a reasonable basis, and I cannot identify net selling price, then what do I consider recoverable value as? I'm left out with one more, right? I still have value in use. So I'll say recoverable value is equal to, recoverable amount is equal to value in use. If I cannot identify net selling price, I will simply consider recoverable value as value in use, since I can't consider this item or I cannot identify that item. What is the second situation? Where there is no reason to believe that value in use of asset exceeds its net selling price. There is no reason to believe that the value in use of the asset exceeds its net selling price. In such situation, what am I saying? I'm saying that I cannot believe that the value in use is exceeding my net selling price. That means which one is higher? I'm expecting the net selling price to be higher. So directly I will say that the recoverable amount is equal to higher of these two, so it should be net selling price. Now, what is that situation where you cannot believe that the value in use of an asset is greater than net selling price? Normally this situation holds good for any asset which is held for disposal. I am holding up saying that I want to sell this asset. I don't have an intention to use this asset only. Now why did I come up to that decision? Because I don't want to use this asset. So I don't have the reason to believe that the value in use will exceed my net selling price. Using the asset, I cannot create sufficient value to exceed my net selling price, so I have hold this asset for disposal today. In such cases, I will say that directly your recoverable value is net selling price. So this holds good for assets held for disposal. when I have designated a particular asset for disposal, then I'll directly consider the recoverable value as net selling price. Now, you'll come up to the first condition. I did not explain anything. I did not say what is that situation where net selling price cannot be identified. Say net selling price cannot be identified on a reasonable basis, then you consider value in use as your recoverable amount. Now, what is that peculiar situation where I cannot identify recoverable value at all? Now, we'll come to that. We'll come to that situation when we are trying to identify your net selling price. Determination of net selling price. In this we will see when is the situation where net selling price cannot be identified on a reasonable basis. Determination of net selling price. Now I want to determine the net selling price of an asset. We will go by a flowchart. If a binding sale agreement exists, if there is a binding sale agreement that exists, if your answer is yes, then my net selling price is equal to price agreed in the sale agreement. Whatever price you have agreed upon in the sale agreement will be called as your net selling price. Let's say there was no binding sale agreement at all. Your answer was no for the first question. Then the asset is actively traded in the market. The asset is actively traded in the market. If your answer is yes for this, then my net selling price is equal to bid price. Now, normally we come across two terms when we are deciding upon a price. One is called as a bid price, one is called as an ask price. Bid price is the price at which I can sell a particular item. Ask price is at which I can buy a particular item. So here we are looking at selling it, net selling price. So that means at what value I can sell. So I am looking at bid price in an active market. Let's say for suppose they are not actively traded in a market. Not actively traded. If it is not actively traded in the market, that means it is still traded, but it is not active. So in such situations, net selling price is equal to, it should be based on last transaction price. I am not saying it is equal to the last transaction price, but I am saying that it should be based on the last transaction price. That means my last transaction price happened sometime 2 months back. Now within the 60 days period, there is a change in the value of the asset. So such changes in the value of an asset should also be incorporated there. So that is the reason why I am not saying it is directly equal to the last selling price. I am saying it is based on the last selling price. So whatever is the last transaction price, adjusted it for changes, then you will get what is the net selling price. No binding sale agreement, not actively traded. It is actively traded, it is not even actively traded also. In such situation when this is not possible, if this is also not there, then that means it is not traded only. If it is not traded in the active market, there's no market for that particular product, then how do I even try to identify? In such situations where I cannot identify, it is not even traded in the active market, then you have to go back. Check here. If net selling price cannot be identified on a reasonable basis, my recoverable value is equal to your value in use. So, if I have a binding sale agreement, net selling price is based on your agreement price. If it is actively traded, then take the bid price. Not actively traded, take the recent transaction price. If that is also not possible, then you can't identify your net selling price at all. In such situation, if this is yes, then I will say your recoverable value or recoverable amount is equal to value in use. Now this is what we have already seen here. So this is my determination of net selling price. Now let's move further. So we have identified how to calculate the net selling price. Now we have to determine how to identify your value in use. Let's see how to determine the value in use. Now what is the value in use? It is a present value of cash flows arising from the use of the asset. Now when I talk about a value in use, I'll have three determinants here. What are my determinants in value in use? The first determinant is cash flows on use of asset. This I need compulsory. I also need cash flows on disposal of asset, because after the asset is already used, I'll have to dispose the asset. Then what is the cash flow that will be generated from the sale of the asset? And the last one which I need to calculate the present value, so I'll calculate my discount rate. These are the three determinants. Cash flows on use of asset, cash flows on disposal of an asset, and the discount rate. Now how do I calculate this cash flows and use of the asset? Because I'm talking about future. So if I'm standing at year 0, I'm expecting that the useful life of the asset is 5 more years. So during this 5 years of the remaining useful life, how much is the cash which is generated by the use of the asset? That is what I'm trying to identify. Now how do you know? Standing in year 0, I'm not an astrologer to tell you what will be the cash flows that will be generated from the use of the asset. So for this purpose, to identify the cash flows, we use management estimates, budgets, and forecasts. To estimate the cash flows. To estimate the cash flows, we use the management estimates, their budgets, their forecasts. My cash flows on use of asset is equal to cash inflow CIF on use minus cash outflows on use. Because for using the asset, I will definitely generate cash inflows. But to generate that cash inflows, I'll also have to spend something like repair and maintenance. Some diesel expenditure, that is a cash outflow on use of the asset. That should also be deducted. Then I will identify what is called as net cash flows. You can call this as net cash flows from use of asset. So my net cash flows on use of asset is equal to cash inflows on use minus cash outflows on use of the asset. Your cash outflows are normally your maintenance expenses for the asset. For upkeep of the asset, whatever expenditure is incurred will be considered as cash outflow. One more very important point. Estimated future expenditure to enhance the performance of asset should not be considered. Tomorrow I might incur an expenditure which might enhance the value of the asset. Then you don't have to consider it today. You consider it when the expenditure is actually incurred. So as on today, when you're trying to trying to get the value of cash flows on year 0, the estimated future cash flows should not take into consideration the future capital outflow of asset for enhancing the performance of the asset. So this cannot be considered. Then, how do you calculate a discount rate? Now my discount rate is a risk-free pre-tax rate of return expected in the market. Risk-free pre-tax rate. Now why did I use a risk-free rate of return? Because my cash flows are already considering the risk. When the cash flows are already adjusted for risk, the discount rate need not be adjusted for risk. Because the cash flows have been already adjusted. Pre-tax rate, because I'm completely taking into consideration before tax for all the cash flows. So cash flows for tax also will not be considered. So exclusions in determining cash flows. Now what are those? It should not be considered in determining the cash flows. First one, tax. Second one, finance cash flows. Interest, dividends and everything should not be considered. Third one, abnormal items or abnormal cash flows. Fourth one, administration and selling expenses or administration and selling cash flows. So cash flows and administration expense and selling expenses cannot be considered in determining your value in use. Now, there's a peculiar situation which arises. This is determination of value in use for an asset generating cash flows in foreign currency. Let's say I have a particular asset which is established outside India which is generating cash flows. And whatever services are being rendered by that particular machinery are being invoicing, are being collecting the money, charging the invoice on the basis of foreign currency. Let's say my billing is done in dollar. So when my billing is done in dollar, then how do I calculate the value in use for that? So my estimated future cash flows are everything in dollars. Now my estimated future cash flows are completely in dollars, but when I'm talking about value in use, I need to get it in rupees. Indian enterprise. Indian enterprise value in use I want in rupee, but my future cash flows are completely in foreign currency today. Now when it is in foreign currency, then how do I determine the value in use is the question. So let's say we are standing today on 31st March 2016. And I said, as for the year ended on 31st March 2017, it will generate a cash flow of $10 million. At the end of 2017, it will collect $12.5 million. For the end of 2018, it will at least generate $14 million. Now everything is in dollars. I have to bring it back into rupees. Now if I have to bring it back into rupee, then I have to use an exchange rate. Now what exchange rate? The $10 million is being generated as on 31st March 2017. Do you know what is the exchange rate on 31st March 2017? Today's date, balance sheet date is 31st March 2016. So 1 year later on, exchange rate I can't identify. 2 years later on, what is the exchange rate? I can't identify. If an asset has a useful life of 10 years, that means for the next 10 years it is generating cash flows in dollars. 10th year cash flow has to be multiplied by the exchange rate of the 10th year. Standing today, year 0, how will you identify? That is not possible. Practically it is not possible. So here comes a situation. What we have to do is, we have to still determine the value in use. Now what do? We say that compute the value in use in foreign currency first. How do you calculate value in use in foreign currency? This is nothing but cash flows in foreign currency multiplied by discount rate for such foreign currency. Guys, discount rate for a rupee, discount rate for a dollar will not be the same. Rupee depreciates much faster than a dollar because the interest rate charged in India is higher than that which is charged in US. So depreciation is faster in a rupee. The discount rate of a rupee is higher than a foreign currency. So what am I trying to do? Identify the cash flows. Cash flow is in foreign currency. Discount rate is also foreign currency discount rate. Multiply your discount rates and cash flows. You will get what is the value in use or the net cash flows or present value of cash flows in foreign currency. Now, this is the value in use in foreign currency on year 0. Year 0, you know, that is 31st March 2016. On 31st March 2016, you know the exchange rate. Apply closing rate. What is closing rate? Exchange rate on balance sheet date. On the balance sheet date, whatever is the exchange rate you apply, that will give you value in use in home currency. Value in use in foreign currency multiplied by closing rate. This will give you value in use in home currency. This is how we determine a net selling price and also we determine your value in use. Once we know how we determine the net selling price and the value in use, we can apply it here. We can identify the higher of each and we get the recoverable amount. Once we identify the recoverable amount, you know the book value of the asset from the balance sheet, you can identify what is the impairment in the value of an asset. That is nothing but the loss or decline in the value of an asset. Very good. Now this is how you measure it. Now we have to come down to the situation of how to recognize it. Now this is measurement principles. how I am calculating the amount of impairment loss. Now how do I recognize such impairment loss in the books of accounts? So put an heading, recognition of impairment loss. First, I'll start with recognition of impairment loss for individual assets. That means obviously we will not stop the standard after recognition of individual assets. We'll have to go for something else which is there in the standard, because probably what we have been seeing is only the elementary part of the standard. The main part of the standard or the practical application of the standard will be after your recognition. Now, how do I recognize an impairment loss? Now, whenever I am talking about an impairment, understand impairment is only possible if your carrying cost of the asset or the carrying value of the asset is greater than recoverable value. Compulsory, right? If you observe, if recoverable value is more, if this is more than the carrying cost, then your impairment will become negative. Can there be a negative loss? Negative loss is not there. Negative loss is called as a gain. And we are not talking about gain because at the beginning itself I said impairment is loss. That's it. So there cannot be a negative loss. So we'll ignore the concept where your recoverable value is greater than the carrying cost of the asset. If your recoverable value is more than the carrying cost, then I'll say that there is no impairment for such asset at all. So impairment will only arise when your recoverable value is lower than the carrying cost of the asset. How do I recognize this impairment loss? Impairment loss recognition is very similar to what we do in depreciation. So what is the entry for depreciation? Depreciation account debit to asset, same thing. Impairment account debit to asset. Asset is reduced with the value of impairment. Now what do I do with the depreciation? Should be charged to P&L. Same thing, impairment also charge it to P&L. P&L account debit to impairment. But if the asset was earlier upward revalued, what happens when you revalue upward? When I revalue an asset upward, I get something called as a revaluation reserve. So when I have a revaluation reserve, don't use your P&L, you can use your revaluation reserve. If an asset was revalued upwards earlier, then we debit a revaluation reserve. If it was not revalued upwards earlier, or let's say it was not even revalued, then debit P&L. Even if it was revalued but the revaluation was downward, then also I don't have a revaluation reserve, I'll still use P&L. How simple? Depreciation. Depreciation should be charged on the revised carrying cost because what happens, why did I call it as a word revised carrying cost? Because you are charging impairment loss, the carrying cost of the asset earlier will be reduced. So the revised carrying cost of the asset should be depreciated over the remaining useful life of the asset. Over the remaining useful life of asset. Depreciation should be charged on the revised carrying cost over the remaining useful life of the asset. That is an extract from A6, guys. If you actually check A6, A6 has two main things. One, change in determinant of depreciation. Two, change in method of depreciation. Change in determinants of depreciation. There are three determinants for depreciation. What is the formula for depreciation? Cost minus estimated residual value divided by estimated useful life. So there are three things that you have used in valuing your depreciation. Cost, estimated useful life, estimated residual value. Now, if there is a change in any of these three items, then always you have to give a prospective effect. That means whatever amount has been already depreciated, I won't change that amount at all. My depreciation impact will be only for the future. For the future period, I will revise the amount of depreciation to be charged. Here also same thing. Carrying cost is changed. Cost is changed, it means you are changing the determinant of depreciation. So that is why I am saying depreciate it over the remaining useful life. So my future depreciation value will change. Whatever you have already depreciated will be unchanged. There is an extract from A6 which has been adopted by AS28 and it is called as prospective effect of depreciation. Now, going by this, we have understood that there is only a recognition of individual assets we have identified. Now, I'll tell you why did I restrict my concept to individual asset. Now, understand, let's say for example, I have two machines, machine A and machine B. Now, I insert a paper here. My machine A is waxing machine. So the paper is getting a coat of wax on it, forwarded into machine B, which is called as a cutting machine. And I get a finished good here. Now, what is generating cash flows? This finished good is generating cash flow. When I am talking about a finished good generating cash flow, which asset did you get that cash flow from? A or B? Now, which asset did you get the cash flow? Now, I am just inserting a piece of paper. It is getting a wax coating on that paper. I am cutting it into pieces, whatever required sizes they are, and I am selling the item. Now, you use that paper in a lot of situations. Basically, we use it for a blade, or we also use it for a chocolate wrapping. So all that you use that wax paper. Now this wax paper, well, if it is a finished good and if it is generating the cash flows, now I am asking you, which asset generated the cash flow? Now is it machine A which generated the cash flow or machine B which generated the cash flow? If you observe, both on a combination have generated. Both on a combination have generated the cash flow. I can't say what is the amount of cash flow which can be attributed to A and what is the amount of cash flow attributed to B. That I can't determine. I can't specifically determine. I can't divide the cash flow there. When you cannot divide the cash flows, then you cannot value your value in use. How do you get value in use? Because we need to consider your cash flows. When I can't identify the cash flow of each individual asset, now on what basis do I do? Or let's say for suppose you wanted to sell also. Now who will buy one asset? Unless and until both assets are there, it does not generate cash flow only. So even the buyer is not interested to buy one individual asset there. So basically both the assets should be considered on a combination basis. Now this is a problem. So not always an impairment loss can be identified for individual asset. The reason is very simple, because most of the situations we find that few assets on a combination are generating the cash flows. Few assets on a combination basis are generating the cash flows. Now let's take the case of this classroom itself. A classroom is generating a cash flow for the organization. There are plenty of assets which are involved. There's a board which is involved, there's a furniture being used here, there's a technology which is being used. Now plenty of things are there. Now is it one single asset? No. A combination of assets. Now unless and until I have this furniture, I don't have this board, I can't generate the cash flow. At the same time, I need the technology to generate the cash flow as well. So unless and until everything is working on a combination basis, I am not generating the cash flow. So that means I cannot identify impairment for individual asset all the time. We have to sometimes adopt combination of assets. This combination of assets is called as cash generating units. Now we'll pick up the new concept. Impairment cannot be identified for every individual asset. Since few assets generate value only in combination. In such cases, determine impairment for group of assets that is cash generating unit. So cash generating unit involves multiple assets. So in a few situations, like we have seen one example, that we have understood, I cannot assign a value for each individual asset on isolation. Isolation, they do not generate cash flows. On a combination, they generate cash flows. On a combination, they generate value to the enterprise. Now in a combination only, I will check for impairment. I cannot identify the impairment for each individual asset. That is what we are trying to prove. And we said in such cases, we will take combination of assets or group of assets, and each group of asset is called as a CGU. Now, if I leave it here, then probably people will start interpreting like this. All the assets of the enterprise put together are one CGU. Over. Situation close. So I'll say only one CGU is there in the entire enterprise. Only one CGU I will check for impairment loss. I will close the issue. If basically I am not trying to identify what is the CGU, then I will definitely go for that. Because it's the easiest way to conclude the standard. Saying that okay, all the enterprise put together is one CGU. But you need to understand what is the CGU and what are the assets which can be included in a particular CGU. So that is the reason why understanding the definition of CGU becomes very important. CGU is a smallest identifiable group of assets generating cash flows significantly unrelated from other assets or group of assets. I'm using the word smallest identifiable group of assets. This word smallest has a highest significance. If this word is eliminated, an identifiable group of assets generating cash flows which are significantly unrelated from the other group of assets or other assets, if I leave it like this, I'll say entire enterprise is one CGU and I will close it. But since he has used the word smallest, then I have to try to identify what is that smallest group of asset which is generating cash flows relatively independent of other group of assets. Now this is the question which comes up. Now, how do I identify CGU? Now, as such, if I talk about, a CGU cannot be identified unless and until you understand the operations of an enterprise. So normally, let's say, it happens to be a situation where a delivery van will also become sometimes a part of CGU. Sometimes it has to become a part of a CGU as well. Let's take a case of milk packets. Now let's say I'm into selling milk and such milk is basically transported in packets. Now, milk, obviously, timeliness of delivery is very important. When you're talking about milk, newspaper, these items, timeliness of delivery is very important. If I cannot deliver on time, there is no value for that product. The value of the product completely deteriorates or sometimes even becomes nil also. So what is happening? Delivery van is doing the duty of timely delivery, so it is also increasing the value of an asset, or it is also trying to generate a cash flow along with the other assets. So that will be bought up as a combination of assets. Sometimes, if delivery was not so significant, I will call that asset as non-operating asset because that is not producing any finished good. That is not enhancing the value of the finished good in any manner. If it is not enhancing the value, then I will not call it as a cash generating unit at all. Got it? So whenever you are trying to identify a group of assets, we have to identify the smallest group of assets which are generating cash flows which are significantly unrelated from other assets. For example, let's say a particular asset A was categorized under one CGU. Should it be categorized under the same CGU consistently? Absolutely yes. Now question arises, can I change the classification? Sometimes yes. Because let's say a particular asset was being used for transportation. Now at a later point of time, let's say it was used for the transportation of employees from their office place to the work or to the home. He has been using that particular vehicle. Later point of time, I started using the vehicle for delivery. Now did I change the purpose? I changed the purpose. When there is a change in the purpose of using the asset, then definitely there will be a change in the classification of the CGU as well. So I'll say assets should be classified to CGU consistently a change in classification can be justified if there is a change in purpose for which the asset is used. So a change in the classification can be justified if there is a change in the purpose for which the asset is being used. Earlier I have been using the asset for a particular purpose. Now I have changed the purpose for which the asset is classified or the asset is used. I'll have to change the classification in such cases. Now, this is how we start with the CGU. So, how do I identify the net selling price of a CGU? Combination of all assets, whatever is the selling price of the assets is the net selling price. How do I calculate value in use? Same thing, on a combination basis, whatever cash flows that they generate, I will consider that as your value in use. Very good. Everything looks very nice. But when it comes to the case of recognition of impairment loss, here creates a problem. Let's say there was an impairment loss. Okay, there was a loss and we have categorized that as impairment because my carrying cost of that CGU was greater than the recoverable value of that CGU. Very good. Now how do I allocate it to each asset? Now a CGU, let's say, has about 6 assets. I have identified one single impairment loss. I am not trying to identify impairment loss for each individual assets. I am trying to identify impairment loss for the entire CGU. Now that CGU has 6 assets, I have identified one impairment loss. How do I allocate it to each individual asset? If I have to record this entry impairment account debit to asset, now what is that credit? That credit which you have given to the asset, which asset? Asset A, asset B, asset C, which asset am I talking about? Now what asset should be credited there becomes a point of question now. Now here we'll have to sort out the issues. Now what he says is, whatever impairment loss has been identified with the CGU, it has to be allocated to each asset of the CGU on a reasonable basis. Very good. What is that reasonable basis? On what reasonable basis can I say that I can allocate the impairment loss? He will say, take the ratio of their carrying value. Whatever is the ratio of the carrying value of the asset, that will be taken as a basis for your impairment loss to be allocated to each asset. So write down recognition of impairment loss. Entries will not change, guys. Entries will be the same. Recognition of impairment loss. Put a hyphen and write down CGU. For a cash generating unit. Now what we are trying to say is, impairment in value of CGU, this value should be allocated to each asset of the CGU. Now how do I allocate it to each asset of the CGU? On a reasonable and a consistent basis. Now what is this reasonable basis? The reasonable basis is in the proportion of carrying cost of assets in a CGU. So an asset in a CGU has higher value, it will get a higher portion of impairment loss. An asset in the CGU has a lower value, it will absorb a lower amount of impairment loss. Recognition of impairment loss in the case of a CGU, it has to be allocated to each asset. Such allocation to each asset of the CGU should be done on a reasonable basis, which is nothing but the proportion of carrying cost of each asset consisting in the CGU. So individual asset is over, a CGU is over. Now comes a portion of goodwill. Goodwill is an asset? Yes. Did I say goodwill is excluded from the scope of the standard? No. That means goodwill has to be impaired now. Now, can I say goodwill can be calculated for impairment as an individual asset? Now, goodwill as such is generating cash flow? No. The assets are generating cash flows, which we are saying that such cash flows generated are more than normal cash flows. So I'm getting extraordinary cash flows. That extraordinary cash flows being generated, we call it as goodwill. Now, can we say that a goodwill is a separate asset? Absolutely no. For the purpose of impairment, goodwill is generated because of each individual asset. That means this goodwill, whatever you have identified in the balance sheet, this has to be allocated to each asset, if possible, or to CGU. Either you allocate it to an individual asset or you have to allocate it to the CGU. Now this allocation becomes possible. What he says is such an allocation, whenever you are trying to allocate it to the asset or the CGU, such allocation should be done by bottom-up approach. Following that, if he says, if bottom-up approach is not possible, use top-down approach. Two new terminologies which we are coming across. One is called as a bottom-up approach. One is called as a top-down approach. We started with saying that goodwill is not an individual asset to be checked for impairment. Now goodwill is a result of the assets within the enterprise generating extraordinary cash flows. That extraordinary cash flows, what we call it as super profits, that extraordinary cash flows is called as goodwill. Now which asset generated that extraordinary cash flows? I have to identify. I have to allocate goodwill to each individual asset. Now either your individual asset or you give it to a CGU, we have to follow two approaches. Either you follow a bottom-up approach. If this bottom-up approach is not possible, then I'll apply a top-down approach. Now what is this bottom-up? What is this top-down approach? Let's see. Every organization has a particular structure. Like Reliance has a head as Dhirubhai Ambani was a head earlier, then later on came Mukesh Ambani and then Anil Ambani. They're the head of the enterprise. Or we normally call them as the managing directors or the managers of the enterprise. Now when we talk about them, they hold the top position. Do you think they'll take care of the entire operations of the enterprise? They're only handling with the decision making process. And that too, they'll have a lot of peers along with them who are assisting them in the decision making process. Now this peers, what we call about, is called as an organization structure. An organization structure is what we are talking about here. Normally when we talk about ICAI, ICAI has a president whom we normally very popularly know. But when we talk about registration for your exams or registration for your course, your registration will be, the DD will be written to the secretary. Yes? Or whenever you are applying for the exams, you will have it to the secretary, the examinations. Now that means what is happening? The president, you are not sending the DD directly. You are basically having a lot of people within him who are handling each issue. There is something called as board of studies. Board of studies is only taking care of this particular segment. You have again this entire segment divided into parts of the organization, like southern region, northern region. You have your SRO numbers. You have an SRO number, NRO number, ERO numbers. Now what is this? They are again divided into divisions now. Now this is basically what we are talking about. Even an organization like ICAI has a structure. Now this structure of organization is what we have to understand. Let's say there was a person X who was heading the organization. He has divided the organization into three parts. North, Central, South. Within each division, I said I perform 3 activities. Activity A, activity B, activity C. Each activity has 3 operations. AA1, AB1, AC1. Each operation is headed by 2 persons. You can call them as ABX, ABY. I'm not taking every wing, guys. I'm just trying to expand further. Now, each one has group of CGUs first. Group 1, Group 2, Group 3. Each group has cash generating units. CGU 1, CGU 2, CGU 3. Each cash generating unit definitely has individual assets. P, Q, R, S. These are my individual assets. This is some sort of organization structure that we are considering. However, your organization structure normally is much more complicated than this simple form. Okay, but still, let's restrict it here. What is he saying? Bottom up. From bottom, move towards the top. Try to allocate goodwill from bottom up. That means, try to allocate goodwill to individual assets. If not possible, bottom up. If you are not able to allocate it to the individual asset, at least allocate it to the CGU. Very good, not problem. You could not allocate it to the CGU, at least allocate it to group of CGUs. If you cannot allocate it to group of CGUs, then stop. So only 3-tier process in your bottom-up approach. That means, try to allocate goodwill to individual assets. If you cannot allocate goodwill to the individual assets on a reasonable basis, try to allocate it to the CGU. If you could not allocate it to CGU, then try to allocate it to group of CGUs. If you could not allocate it to group of CGUs, then don't try to allocate. Then, we have to come for this. If bottom-up approach is not possible, use top-down. Then you'll say, if top-down approach is not possible, then use some other method. No. I'll tell you one simple logic. Top-down, from the top. One enterprise, one goodwill only will be there. In an enterprise, in a balance sheet, when I see goodwill, there's only one goodwill. So that goodwill is anyway there for the enterprise, right? So top-down approach, already you have allocated goodwill. Already the goodwill is allocated for the entire enterprise as a whole. Now I am trying to allocate whether I can allocate it to each division or not. Northern division is making huge profits. Central is making medium profits. South is incurring loss. So where is the goodwill? The goodwill is at a place where there is higher profits. So that means the goodwill should go to either the northern region or the central region. Highest to the northern region and slightly lower to the central region. Then I will try to allocate it to ABC. Then I will try to allocate it to A1, AB1, AC1. That means I am moving from top to down. If you observe, you cannot fail in this method. You cannot fail. Their failure is not a chance only, because starting with the top-down approach itself, you started with the enterprise level, you have already allocated goodwill. You have already allocated goodwill. Okay, no problem. You could not allocate it to northern, southern and central, no problem. You have already allocated it on an enterprise level. So allocation of goodwill is already completed. So that is the reason why bottom-up approach has a restriction. I cannot go beyond 3 levels, but top-down approach, you can come down as much as possible down your levels of hierarchy in the organization structure. Got it? So you could allocate it here, you can allocate it here. Here it is not possible, but normally the organization structure is much longer than this. So there will be plenty of stages at which you can allocate goodwill. So this is a simple technique for you to understand, or a simple illustration for you to understand the bottom up and a top down approach. Bottom up approach is a 3-tier process. Try to allocate it to individual assets. If not possible, then CGU, that is group of assets. If not possible, then go for group of CGUs. If not possible, then stop your bottom up approach. You can start adopting your top down approach. Similar techniques of goodwill have to be allocated even to corporate assets. Now, why should I adopt even for the corporate assets? Corporate assets do not generate cash flow. Corporate assets do the function of administration. They are administering the entire resources. Now, this is the work of a corporate asset. So, a corporate asset, in the sense, an AC fitted in the managing director's cabin, is it generating cash flow? No. So, does it mean that I remove the AC? No, right? So, there is some value addition from whom? From the person who is working there. So, whenever you talk about a corporate asset, as such it does not generate any cash flow. But it has some significance in generating cash flows from other units. So, in the same way, as you allocate goodwill, you also allocate your corporate assets. Allocation pattern is similar for both. Got it? Corporate asset, if someone will say, I will check for impairment loss for every corporate asset individually, no chance. Corporate assets cannot be an asset to be checked for impairment. Corporate asset has to be allocated. Has to be allocated, and only then you can check for your impairment loss. We have already seen two recognitions. Recognition of impairment loss for individual asset, recognition of impairment loss for a CGU. Now come to recognition of impairment loss for a goodwill. Be it for individual asset or for the CGU, the first asset to absorb the impairment loss should be goodwill. You have allocated goodwill to individual asset or you have allocated goodwill to the CGU. The first asset that will absorb the impairment loss will be the value of goodwill. Let's say, for example, the individual asset or the value of the CGU was 100. Goodwill allocated was 20. Impairment loss was 25. So what I'll say, first I will eliminate the 20 value of goodwill. The balance of 5 impairment loss will be given to the asset there. So the 100 rupee of asset will be reduced only to the value of 95. But let's say, for example, the impairment loss was only 15. So what will happen? I will eliminate the entire 15 from the goodwill. No impairment loss to be recognized against any other asset. So remember your simple logic. Your goodwill allocated to CGU, your goodwill allocated to individual asset or group of CGU, whatever it is. If there is an impairment, then the impairment should be first adjusted against the value of goodwill. So put on heading recognition of impairment for goodwill. Impairment should be first adjusted against the value of goodwill. Balance impairment, if any, should be adjusted against the CGU or individual assets. Even if you allocate it to CGU, again it will come down to individual assets only. Now, this is the concept for goodwill and their impairment loss. Now, before we can conclude the standard, we have to touch upon one more small concept called as reversal of impairment loss. I am not talking about a gain on impairment. It cannot be a gain on impairment, but I am saying that it is a reversal of impairment. Reversal of impairment means whatever loss you have earlier recognized, I am trying to adding it back. Reversal of impairment. Now, to understand this concept, I'll take a small example. Let's say year 0, my carrying cost of the asset was 100. I have recognized an impairment loss of 30 here. So what is the revised carrying cost? My revised carrying cost is 70. So my depreciation should be charged only on this 70 rupees. Let's say my remaining useful life is exactly 5 years. Then the depreciation to be charged every year 14. If I have charged depreciation at the rate of 14 every year, for year 2, carrying cost will be 70 rupees, that is a revised carrying cost, minus 2 years I have already depreciated 14, so 2 into 14, 2 times being depreciated for 14, the value will be left out is 28 you reduce, so 42. The carrying cost is 42 at the end of second year. Let us say this year there is a reversal. There was a reversal to the extent of 30. So will the carrying cost become 72? Answer says absolutely wrong. Answer is absolutely wrong. I can't take 72 just because my impairment loss earlier was 30. I can't take reversal also to the extent of 30. Then how will I consider reversal? Now check. Considering there was no reversal, no impairment, what would have been the value of the asset? If there was no impairment, then the carrying cost of the asset was still 100. My remaining useful life unchanged would have been 5 years. Depreciation every year would have been 20. So my carrying cost at the end of year 2 would have been 100 minus 2 years I have depreciated by 20. I would have come down to 60. So what he says is, even though the reversal of impairment loss is 30, my reversal cannot be 72. He's saying that it should be subjected to a maximum of 60. subjected to maximum of 60. So I'm saying maximum reversal of impairment possible is equal to 60 minus 42. If no impairment loss was recognized earlier, my carrying cost would have been 60. Since there was a impairment loss recognized earlier, the carrying cost was only 42. So the maximum reversal I can carry is only 18. Though my impairment loss recognized was 30, the maximum reversal can only happen to the extent of 18. Now, how did I get this 18 figure? In a simpler sense, I'll say 30 rupees was the impairment. If you have reduced the carrying cost of the asset, you have also reduced the depreciation to be charged. Earlier, depreciation to be charged at 20, but now you are reducing the charge to the depreciation at only 14. So how much did you save? I saved 6 rupees. How many years did you save? 2 years. So if I save 6 rupees every year for 2 years, I've saved 12 rupees. How much was the loss debited? 30. How much I did not debit to P&L? 12. So 30 minus 12, the answer is 18. So basically I will say that it is 30 minus the saving in depreciation. The saving in depreciation is 6. Since you have impaired, the value of depreciation debited to P&L is only 14 instead of 20. So you are saving 6 rupees in the form of depreciation for 2 years. I saved 12 rupees, but I debited 30. So a maximum reversal can happen to the extent of 18 only. So in putting in words, we'll call it like this. Reversal of impairment should be subjected to a maximum of carrying cost of asset if such impairment loss was not recognized earlier. If such impairment loss was not recognized earlier. If you remember, I told you, check for impairment only if there is an indicator of impairment. Such indicators of impairment are split into two parts. Internal sources of information and external sources of information. These internal and external source of information are explained in para 8 of the standard. It's a theory part. You can check your standard from the given material. You'll get what is a para 8. It's only pure theory part, guys. You can refer to those internal and external sources. You don't have to by heart anything from the internal and external sources. It's just how to indicate whether there's an impairment loss or not. Now, if you remember, there was a relaxation which I was referring to for the SMEs. Relaxation or exception for the SME at the time of applicability, I told you, SMEs are relaxed from a small part of the standard. Very, very tiny relaxation. What he says is, value in use. Normally what did we see? Value in use is a present value of cash flows. But he says, for SME, value in use is equal to a reasonable valuation of future benefits arising from use of asset. He just used the word reasonable valuation. That means I don't have to calculate the cash flows. I don't have to check for the discount rate. I don't have to calculate for the present values at all. If I take a reasonable valuation of value in use, that is sufficient for small and medium enterprises. However, if it is a level 1 enterprise, then you have to check for the cash flows. You have to determine what is the discount rate, identify the discounted cash flows, and identify the amount. This is the relaxation which is given for SME. Now, before we conclude the standard, we need to take up a very peculiar concept. Well, when we know that the impairment loss, how do you calculate impairment? Impairment of an asset is equal to carrying value minus recoverable amount. Now, what is this carrying value? What is this recoverable amount? Now, we have already identified these terms, but normally if I go with the concept, I will say that impairment is either less than or equal to carrying cost. Am I true in saying this? I am saying that my impairment cannot exceed the carrying cost of the asset. Yes or no? An asset has a value of 100. Carrying cost of the asset, book value of the asset is 100. So does it mean that the impairment loss cannot exceed 100? True. Because if I take recoverable value as 0, then carrying value will be equal to the impairment. And properly it is less than. But there is a peculiar situation. There will be a situation, a particular scenario which will arise where my impairment is greater than carrying cost. Now, how did this come into picture? Impairment loss is more than the carrying cost. Impairment loss is equal to carrying cost minus recoverable value. Even if you take recoverable value of 0, impairment loss is equal to carrying cost only. But I am saying there is a peculiar situation where impairment loss can be greater than the carrying cost. If this negative becomes a positive, then definitely I will say that impairment loss is greater. For this negative to become positive, your recoverable amount should be negative. So this situation is possible only if recoverable amount is equal to negative. Very good. can you have a negative recoverable amount here? Something or the other I'll recover. This is something. Okay, net selling price. Or I'll leave the asset, I'll throw the asset out and I'll come back. Still zero. Now what is that situation where recoverable amount is negative? That situation arises, guys. Let's say there was a particular law which was enacted. Okay. Earlier, long back, this was the situation saying that the 2-stroke bikes are not allowed to run in India. Said only 4-stroke bikes can be manufactured. 2-stroke bike cannot be manufactured because of whatever pollution norms they wanted to put up. Very good. Now because of this rule, all those machinery which were engaged in manufacturing 2-stroke vehicles have to be shut down. Can I sell? I can't sell. Who will buy? When I'm saying that there's a law, the law is applicable to everyone. So that means this particular machinery which cannot be sold to anyone, cannot be used, value in use is zero, net selling price is zero, absolutely wrong. Now I have to dismantle the asset. I have to remove the asset completely. Now when I have to remove the asset, I have to leave the asset, lift it and put it aside somewhere, abandon the asset, there's a cost which is incurred. There's a cost which is incurred on disposal because your net selling price is equal to estimated price from sale minus estimated cost on disposal. If your estimated selling price is zero, I still have estimated cost of disposal, your net selling price will become negative. So when your net selling price has become negative, your recoverable value is negative, then your impairment is greater than the carrying cost. If my recoverable value is equal to net selling price, we have seen this situation where recoverable value has to be taken as net selling price if there is no reason to believe that the value in use will be greater than net selling price. The asset itself cannot be used. I am holding it for sale. But if in that situation where my net selling price is equal to estimated cost of sale, estimated selling price minus estimated cost of disposal. If I say that this is zero, nil, then my net selling price is equal to minus estimated cost of disposal. Net selling price is equal to RV, so this will be taken as recoverable value or recoverable amount. If recoverable amount is negative, then tell me what is the impairment. Impairment is equal to carrying cost minus recoverable amount. If my recoverable amount is minus estimated cost of disposal, this minus of minus will become plus. So impairment will be carrying cost plus estimated cost of disposal. I'm using simple math, guys, in deriving it, and now I've come down to a peculiar situation where my impairment is exceeding the carrying cost. Okay, tell me how to record it. Impairment is a loss, debit all expenses and losses. Impairment account debit. Correct. I have to reduce the value of asset to asset. How much? I can only reduce the value of an asset only to the extent of carrying cost. How can I credit the asset for an extra amount? Asset has a debit balance to the extent of carrying cost. So when I credit the asset, I can't credit it beyond the carrying cost. So my asset can only be taking it as carrying cost. That's it. But what is the impairment? Impairment debited is carrying cost plus estimated cost of disposal. So this extra debit, whatever is there, I'll have to compensate it with the credit, and this credit will be called as a provision for disposal of asset. Peculiar situation, guys, already been tested in the exam. Very unique situations. You don't get such situations normally, but there is a peculiar situation where your impairment exceeds the carrying cost. Beyond the cost of the asset, I can't debit or I can't credit the asset for beyond the carrying cost. So that extra amount of impairment should be credited to the amount of provision. Impairment treatment should be transferred to P&L is same. That will not differ. With this particular concept, we come to the end of the standard AS 28.